Thank you for this kind introduction, and it's indeed a pleasure for me to present in this esteemed audience. Of course, I may have met most of you in the course of last many years, as you know, I've been regularly traveling to Chennai over the last many years. So I'll just cover the application of behavioral finance. Long back, not very long back, 5-6 years back, I read a book on behavioral finance by James Montier, and that really changed my I would say my professional life. I became a far better investor. So I just thought I will share those learnings because in a way you guys are also a fund manager. I am probably a fund manager investing in stocks. You're doing a very similar job investing in mutual funds. So whatever applications are there for me, the same holds good for yourself as well. Now, coming to the main decision making, it is said there are two types of decision making. One is where you have to be extremely fast. Like, for example, if one of our loved ones has an emergency, we can't be sitting and analyzing which hospital to take, where to take. You just have to take to the nearest hospital. Here, time is of essence. We cannot be sitting and analyzing. The second one is obviously where we have time on our hands. We have to sit and analyze what is the problem, what is the best decision making, what are the pros and cons. Now, I'm sure if all of us, were to analyze the last 10 decisions we may have taken, probably two of them would be of the first, where time is of the essence. Somebody needs to be rushed to the hospital. We need to do this, that. The second one is, where we probably need to take we have time on our hands. We need to take a very logical view. Now, the issue is that the brain cannot solve the things fast. It needs time to process the information and come out with the right logical outcomes. But if we sit ourselves and see how the last 10 decisions we have taken, probably, as I said, two would have been fit enough for X system, which is on the left side. 8 would be on the right. But maybe we have taken 5. A lot of times we take a very impulsive decision. It could be like choosing a restaurant or choosing a flight or choosing a hotel. Very, very simple things. And then later on we come back and say that, oh my God, I should have thought it much, I should have done a very detailed analysis. Maybe I could have come with a different and a better outcome. Same where in the investments, I do find that all decisions have to be analyzed and taken. But there could be one or two decisions which is taken in speed, without thinking, without logical. Like, I'll just give a very practical example. Every year, and these days probably it's become months, I do have a stock of mine, portfolio of mine, which falls 10%, 15%. Then I do have people telling me more negative things on that stock or on the sector. And I'm always tempted to go and sell it. And if I sit back and analyze all such falls, it's very clear that whatever price action has happened for the day, it has captured all the negatives, and there's no point in selling it at that price. If you go back to history and see, in most of the cases, whatever price falls happens in case of earnings miss or any other issue, it happens in the first 2 days. Afterwards, there's no point in selling. But still, there is so much of pressure, there is so much of short-term pressure, that sometimes we end up selling when actually probably it needs to be bought, or maybe no action needs to be taken. So it's very important that we apply our decision making. The same thing is applicable for you as well. Whenever there is an event, some fund manager change has happened in a fund, or there could be many issues, rejecting a fund because of some personal bias, it is important that you employ the second part of decision making, not take a decision in haste. I think, as I said, investment is a thing where 100% of the decision needs to be taken after analysis. But logically, when I'm taking 100, 200, 300 decisions in a particular year, there could be one or two which could be done in haste, but this cannot be a higher number. This cannot be a 10% or a 15% outcome. And one of the rules I have at least imposed on myself is that whenever a stock of mine falls 10% or a 15%, or when there is, you do find, for example, the IT stocks were all down 7-8% when the news came last week. I have imposed a rule on myself that I will not sell on that particular day unless it's a, Satyam kind of an event. But I will definitely not sell Maybe I will take some time to digest and take a call after some time, but it's very important that, I have this process in mind to ensure still there could be a case where I could be impulsive. Fine, one or two decision is fine, but anything beyond that clearly affects the investment outcomes. Now, this is the most important thing. In fact, my boss, Vetri, told me long back that you sit and write down your own mistakes. You may not show it to me, so I don't show those mistakes to my bosses, but I have a practice of writing down my mistakes at least once in 6 months, what I have done, where I could have done better. And what happens is a lot of times ego takes center stage and you may not want to accept a mistake. And in our case, what happens is we suffer from two biases, what is called a self-attribution bias. What that means is, see, all our successes are an outcome of two issues. One is skill and luck. When skill and luck combines, I think we are not able to distinguish between both. Sometimes successes, we are able to attribute it to skill, and failures, we attribute it to luck. But that's not always the case. It's always a combination of both. So, analyzing your mistakes will make it very clear whether it was a lack of skill or a luck. Even if it is a lack of skill, no issues there. It's a learning point so that you could kind of go up. So just to give a practical example, when I was writing down my mistakes, I realized that I have a bias towards holding companies, and I was going to them because they were at a 50% discount, 40% discount. Then after going through that pattern, I realized that most holding companies will trade at those valuations. There's no point in me getting into it trying to get an alpha. I have to get into it only when I see something bigger than that. So after that, I avoided investing big time in holding companies. So that, became a very big lesson for me. So analyzing your mistakes to see if it is luck or a skill, I think it's very, very critical that we don't repeat the same mistakes. And fortunately, we are all in a profession where even if we make 30% mistakes, I think we are a very, very good investor. Unlike, say, on a lawyer or a pilot or other professions or even a doctor or a surgeon, where a single mistake can cost his profession, we are very blessed. So we are like, since the T20 World Cup is going on, we are like bowlers. In a T20, a bowler can bowl three very bad overs, yet take 3 wickets in the last over and become a match winner. Unlike a batsman, if he gets out first ball, he's out. He doesn't get a second chance. So we are in a very fortunate space that we can make our mistakes and still, kind of get away with it. But the most important thing is that we should ensure that our mistakes are contained, not more than 25-30%. And more important, they are not big. They don't become big so that they kind of impact us. And the best way is to write an investment diary. So I write logical reasons for whatever I do. And wherever I make a mistake, I also make a note of it so that I don't end up making the same mistake, say after a year or after 6 months. And I think this is a very, very important thing which all of us as investment professionals needs to do, because accepting a mistake is very, very difficult. Which again leads to the most important point. Now, I'm sure all your clients would be coming if you were to tell your client that, this mutual fund investment has not gone well, please sell it. It's at a loss. The first thing the client will ask is, why should I sell it at a loss? The concept that every investment I do needs to be at a profit, I think that is something ingrained, including in me. Now, fortunately, for me, since all my portfolios are mark to market, I don't have this concept of profit and loss. But what mistake I do make is more of an emotional attachment. Like, for example, if I take if I take 1 year to analyze a company and make an investment, and after 6 months, if there is a mistake, I may not want to accept it because there is too much of mental strain and effort gone into that decision making. I may look for other confirmation biases to see that, I'm not making that mistake. I may look at more positive reports, talk to people who are positive on the company. So that's the kind of loss aversion that I have. but maybe deep down at the retail level, or sometimes even at your level, I think you also would have that fear that why should I, book a loss? Let me wait for the better times to come, then I will exit at a loss. But then there are far, far better opportunities which are awaiting. Sometimes it's better that you realize that we have made a mistake and exit a stock. So in this particular book, there's one statement which kind of influenced me quite a lot. Like, successful fund managers have sold higher share of realized losses, while underperformers have sold their winning positions. Now, what this means is that the people who are successful, they have accepted their mistakes and sold their losses and realized their losses. Whereas people who are not so successful, they probably sell their winners early and they hold on to their positions, thinking that, okay, sometime the stock will come back to the previous level, sometime this will make money. And that's what distinguishes between a good and an average fund manager. And especially, I think, since, I have encountered with so many retail investors, my friends, my family, one challenge I face is there is a big aversion to booking losses. Whenever I tell them, okay, sometimes, this mutual fund has gone wrong. I have, I invested in the sector fund, it's down 10%. I tell them to book your losses, maybe it can go down further. Immediate reaction is, why should I book a loss? I think there is that aversion to book loss. And I think it's very critical that you guide them, that, being MFDs, you guide them that it's okay if you book a loss as I said, even a 30% hit ratio, even a 70% hit ratio is very good enough to make you a very successful investor. So I think this is one very important lesson, or, loss aversion is something which affects us. As I said, I may not look at loss. So for me, I don't care whether it's a profit or a loss, but I think for me, the bigger thing is more on the emotional side. The second is contrarian investment, ideal thing. A lot of people have asked on IT. I am also a big overweight on IT. Clearly, I find to be alone. Not many funds are overweight on IT. I have people asking me. So the challenge in any contrarian strategy, or when you are recommending any fund which is not recommended by anybody, is the fact that people question you why. When nobody is recommending, why are you recommending? Why are you not recommending X, Y, Z? I think only if you go outside the group, only if you think outside the group, that is the way to make money in any stock or in a mutual fund. So it's very important that we practice contrarian thinking, think aloof, think outside of what the normal perception is. So see, today, for example, most mutual funds are done on the basis of performance, but also look at funds which show promise, not performance. That can make a very big difference to your clients' outcomes. So lastly, just a summary of the key learnings. As I said, use your mind in all your decision makings. Make a summary of your mistakes. This is the most important lesson that I have learned. And seek contrarian views. Like, for example, if you're very bullish on something, try to talk to somebody who's bearish. Like, for example, for me, I always seek out to meet analysts who have a very different opinion from what I have. So today I'm meeting IT analysts who are very negative on the sector, just to understand what their perspective views is. And last but not the least, follow a very strong process in all your decision making. I think that will help you quite a lot in terms of outcomes. We don't have control on the outcomes, we have controls on the process. So I'll just stop here, and thanks for giving me this time to make this presentation.